This is Daybreak Asia. We're counting down to Asia's major market opens. And Paul, there's really a lot for investors to be digesting this morning. We've had major big tech earnings out, Alphabet, also Microsoft in focus, AMD. But then here in Asia, we've also got that watch on the Samsung numbers and what that's signaling to us about chip demand.
Yeah, that's right. We're keeping an eye on that, on the chip demand story, but the net profit, the bottom line for Samsung was a pretty healthy beat. So we'll continue to listen to what unfolds on the earnings call there. But yeah, it's all about tech in the Asia Pacific today. Here in Australia also, we're waiting on very important CPI numbers. So data-heavy day, Belle.
Yeah, that's right. Really important for the RBA ahead of its decision. But let's take a look here about how Korea and Japan are coming online. But at the start of the day, as I said, that focus on how Samsung starts to trade unchanged at this point in time, but it does take a few moments to show live pricing. As you said, the numbers, so we saw the fourth straight quarter of profit decline. It was in the all-important holiday quarter as well. So net income falling 74% in the last 3 months of the year to 6.02 trillion won. That was a very handy beat on what analysts had been expecting for around 3.2 trillion won, so roughly double that. But it is thanks in part to a tax credit. The chip division, really the one to watch, and that had an operating loss of 2.18 trillion won, more than analysts had been projecting, so not a great signal for the health of the chip sector, though they were in line with the preliminary figures that we had at the start of this month. So you are seeing Samsung here just coming online to the downside of 0.8%. Perhaps also playing into that, though, is the theme around earnings, because AMD as well giving a very weak forecast for the current reporting period. That tracked Intel earlier this week, so not great signals coming out, even though we actually had fellow memory maker SK Hynix posting a surprise profit earlier this month. Let's change on and take a look at what's happening in the session in Japan as we start to come online here. Here the focus is on the data, because we had retail sales rising just 2.1% year on year, so that was far short of what economists had been expecting. It's an important one to be tracking, especially when you put it against the summary of opinions we just had from the BOJ for the January meeting. And this told us that officials are starting to become even more data dependent, because they are watching for when will be the appropriate point to exit away from negative rates. They are saying that they're getting closer to that point, but still they do need to be checking, as I said, the specific data, and that is just one of the ones they could be tracking, retail sales. So, Paul, really the focus on data, as you said, we've got those Aussie numbers coming up for inflation, but also that watch on what we're seeing in after hours.
Yeah, also China PMIs we neglected to mention are coming up later as well. But in terms of those US tech names after hours, we're continuing to see them grind a little bit lower. Microsoft, the better performing of the three that you see on the screen there. Microsoft did have a narrow beat on revenue. Cloud was a beat as well, but expectations around what's happening with Microsoft and the cloud were somewhat higher than what Microsoft ended up reporting. Alphabet, meanwhile, had a narrow miss on revenue. So it's really being punished for that. The search business in particular, falling short of what investors were looking for. Advanced Micro Devices, meanwhile, AMD saying first quarter revenue going to be about 5.4 billion. Well, that fell short of what analysts were expecting as well. And it kind of echoes also what we've been hearing from Intel in terms of its a downbeat view of PC and data center chip markets as well. So those big names all moving lower after hours, Bell.
Yeah, and that focus as well on the Magnificent Seven. These are just some of the numbers we're getting from those companies over the course of this week. So let's discuss with Redmond Wong. He's Saxo's Chief China Strategist and joins us here in the Hong Kong studio. So, Redmond, I know you don't cover big tech specifically, but I'm interested in what that signals to you, because we have seen big tech really leading the gains for the S&P 500. Shares do seem a little bit priced to perfection, though.
Yeah, I think you put it very right. I mean, really, it's the price, really priced in really for perfection. I think they're doing okay. I mean, the earnings are not bad at all. But we just think that the expectation really high. So, but overall for the first quarter, and I mean, it's this quarter. I mean, looking back in the fourth quarter earnings, I think probably will still be in line, and I think the market probably will be okay. But going into it's the next quarter when we're looking back for the first quarter, I think people probably will be more worried, and there will be some more volatility in the big tech sectors. Yeah.
And what do you think is going to be the big driver of that? Is that going to be perhaps the Fed staying high for longer as well?
We don't think the Fed will stay high for longer. In fact, we think that they are going to cut in March. In fact, they probably will be taper in the quantitative tightening very soon. So important, of course, to watch what Powell say, what message he's sending out, but probably will not be very hawkish. And I think so that will continue to support the stock market in the meantime. But I think our more worries in the second quarter is probably when we look back on the first quarter data, both on the earning and also on the economic data, that will probably start weakening, and especially economic data, we will be seeing some weakening. And so we have, I think, the trend in inflation coming down very fast, maybe faster than the market expected, so that we support the Fed's tighter easing case. But the economy and the earning will start be the problem for. But I mean, at the moment, it's not the market's focus. I mean, the market at the moment will support by the Fed expectation.
Yeah, in terms of market expectations around what the Fed does, we've really seen those expectations whipsawing around, particularly when it comes to March. Consensus seems to be now that we're not going to get anything in March, but the focus now on May instead. How much of this is priced in? When easing actually starts to happen, or what sort of moves do you anticipate?
I think we are still expecting it's still more likely for the Fed to make a move in March. So because expectation now actually move it more towards May, and so if they really deliver in March, probably will continue to support the market. So it's when we are moving towards March meeting, I think that probably will continue to support the bond market as well as the stock market, and also after that also will be supportive. But further down the road, and as some of the weaker data start hitting the market, that would be a problem. I think the key thing is inflation. We think that's going to undershoot. So I think that's why we say that is still very likely for March. And also the quantitative tightening issue, I think that is also will be supporting the market.
I want to turn to China now, if we can, because I know this is a key risk for you heading into 2024. We've seen the CSI off about 2.5% this week, the Hang Seng down about 1.5%. What's your grade for policymakers when it comes to trying to put a floor under these markets?
I think that's not a lot the policymaker can do. I mean, they have set the tune and the grand strategy for deleveraging. They are not going to reverse course for that. And the property market is going to have problem for a few years before it has to make the adjustment. It's not going to come back. And I think that it's not going to be a huge financial meltdown. It's not going to happen. I think it's manageable, but it's not going to come back to support the economy. So if the trend growth in China is still coming down to the 4-ish, and then maybe even to 3 a few years later, I think because the decline in productivity, decline in return to capital, I think what we need to see a really resumption of higher growth is have to be more marketization, going back to the reform agenda, and we are eagerly to look for any sign from the leadership for that, but we have not seen anything yet. And the Fed panel may be a catalyst, but we are not putting a lot of hope for that from there.
So then in that sort of environment, how do you boost productivity really?
I think it's really you have to bring back the confidence of the private sector, because the private sector is actually the one driving innovation, and also marketization will actually release productivity. And industrial policy, I think that's the strategy the Chinese leadership now doing, will benefit certain sectors, certain industry. So investors can still benefit, finding some alpha in some of the industry, some of the stock that benefit from that industrial policy. But the overall economy, overall market, if we need a more sustainable bull market, we need to see they going back to the playbook of the 2013 60 points guideline, that decision actually calling for more marketization, but they are not doing that at the moment.
Yeah, well, I was going to say, like, how realistic is it that they actually do open that playbook, because it doesn't seem to be the current policy priority.
No, I think so. That is the key problem. I think so that we are still expecting lower trend growth. So that will be some rebound. I mean, the market has the conditions set up for a decent rebound because of the low valuation, because of the pessimism, but those are not going to be sustainable, and those that is not going to bring back a bull market. Yeah.
All right, Redmond Wong, Saxo's chief China strategist. Let's turn back now to Samsung, if we can. Take a look at how shares are tracking at the moment. We're off about 2/3% in the early going. And this is after the company posted its fourth straight quarter of profit decline in the holiday quarter. Let's bring in managing editor for Asia Technology, Edwin Chan, for more on these fourth quarter results. The net numbers look pretty good, Edwin, a pretty handy beat there. What are your key takeaways so far?
Yes, I think it looks like a handy beat, but a lot of that came from a tax credit, potentially a one-time tax credit. Once you strip that out, I think it's more or less in line, and maybe looks a little weak. I think if you drill down deeper into the numbers, you'll see that the chip division, the one everybody is watching, actually had a higher than expected loss, and I think that's weighing on the shares a little bit. The rest of the numbers kind of look in line with what we expected. I think the real action will start in a little while when executives brief analysts on the post-numbers conference call, and that's when they're going to talk about the outlook for the market and their own plans to catch up in AI and so on.
Yeah, what would we want to sort of see in terms of AI, do you think, to try and boost investors here?
I think, to be very honest, they've lost a little momentum on that front to their arch rival Hynix, which is kind of getting all the attention now for what they call high bandwidth memory, a type of chip that's kind of specialized for AI services, especially for generative AI. So I think investors want to hear Samsung's plans to catch up to Hynix, to invest more in that sphere, and sort of retake, if it can, the momentum and kind of stake its place in the AI sphere. I think that's one main concern of investors right now. The other, of course, is the state of the chip market. We're in kind of a 1-2 year depression right now, and people are interested in knowing when we will climb out of this trough and finally see a significant recovery in chips and electronics and smartphones and so on.
Yeah, what do we get sort of in the smartphone division? Because it seems like they maybe sent some mixed messages on the mobile market a little bit.
In terms of smartphones, I think actually there is a little buzz around the latest Galaxy S24, which they are hyping up as an AI phone, an AI-enabled phone. I think early numbers have been promising. And it's sort of a front runner of its kind, in terms of trying to integrate AI services into your smartphone. And if this catches on with consumers, it's conceivable that we'll see some life in the smartphone market this year. At the same time, the replacement cycle just isn't what it is. And, if consumers decide that there is no real innovation with the newest lineup of smartphones, then we may be in for a bit of a choppy recovery in that market.
That was Bloomberg's managing editor for Asia Technology, Edwin Chan. And you can also turn to your Bloomberg for more on Samsung. You can go to TLive Go to get commentary and analysis from Bloomberg's expert editors, as we said, awaiting more details on those latest numbers. But let's take a look at how markets are reacting as we're seeing Samsung is a little bit under pressure here today. But there's also another reason or another factor that's playing into this, because we had AMD, a fellow chip maker listed in the US, giving a weak revenue outlook, tracking as well that sort of guidance that came out from Intel early this week. But those factors together tell us that the demand in the chip segment is still remaining sluggish, and we're yet to see fully those signals that we're starting to recover here, as Edwin was just saying. But you do see these stocks that are dropping, particularly SK Hynix here, down more than 2% at this point in time. It is that after-hours focus as well. Let's take a look at how big tech companies or tech companies are faring in Asia after we had those numbers out from Alphabet and Microsoft earlier. Again, investors really clinging to some of the more negatives in these numbers. So, for instance, in the Alphabet one, it was that focus on search revenue that disappointed. Microsoft, the focus on cloud growth, that also didn't live up to everyone's expectations on Wall Street. And so we did see those shares dropping in after hours. Alphabet, you can see, down more than 5.5%. But that certainly is playing into the tech story broadly in Asia, Paul.
All right, we have plenty more coming up. The IMF sees brighter prospects for global growth this year, even as risks from wars and inflation persist. We've got more from our interview with their chief economist just ahead. First, though, President Biden says he's decided how to retaliate for the deadly attack on U.S. forces in Jordan, as the White House hints at multiple actions over time. Details coming up. This is Bloomberg.
The battle against inflation is being won, and that's a very positive development. It could continue, so we could have even more good surprises on the inflation front, and that would allow central banks to ease monetary policy sooner, and so that would help lift growth. On the downside, we're concerned, of course, about geopolitical risks. We see what's happening in the Middle East, in the Red Sea. We're concerned that, there could be a tightening of financial conditions that would increase interest rates even further than where they are right now.
That was the IMF chief economist Pierre-Olivier Gourinchas on the outlook for the global economy and really referencing those geopolitical risks. But as he said, the tensions in the Middle East, and President Biden saying he's already made a decision on how to respond to a deadly attack on U.S. troops in Jordan. But he says he also doesn't want to spark a wider war in the Middle East. Bloomberg's Bruce Einhorn joins us now. And this is any sort of response here is going to be significant, not just for the region, the U.S., but also the global economy.
Yes, and as the president said, the U.S. feels that it needs to respond because while there have been dozens of these attacks since October, when the war between Israel and Hamas started, this is the first time that there have been American fatalities. The president said that I don't think we need a wider war in the Middle East. That's not what I'm looking for. His national security advisor, his spokesman for the National Security Council, was briefing reporters, said that it's likely that there'll be a multi-pronged response, that we won't be seeing one big attack, which is something that a lot of Biden critics in the U.S., say from the Republican Party, have called for. Instead, we're likely to see what the spokesman called a tiered approach, not just a single action, but potentially multiple actions over a period of time. So the risk there is that if we have multiple responses, then there could be responses to those responses over time. So the situation could just deteriorate.
Yeah, ripe for escalation indeed. But let's take a look at the situation in Gaza as well. The main UN relief agency there, UNRWA, on the brink of collapse. Bruce, what's the future for it?
So a spokesperson for the agency warned that the agency would not be able to continue beyond February currently because of the cutoff in funds. At least 16 countries, including the U.S., have cut off funds to the agency following reports that Israel provided to the UN that 13 members of the agency were involved in the Hamas attacks, the massacre on October 7th. Israel also says that about 10% of the agency's workers are members of Hamas or Islamic Jihad. Mitch McConnell, the leader of the Republicans in the Senate, on Tuesday vowed to prevent any further U.S. funding to the agency. The U.S. ambassador to the United Nations, Linda Thomas Greenfield, she said that while the agency does provide important work, she also said that we need to see fundamental changes before we can resume providing funding directly to the agency. The UN Secretary General Antonio Guterres, trying to do some damage control here, met with about 36 officials from about 36 countries yesterday, trying to address the situation. But for the moment, it does seem like there's a bit of a crisis when it comes to humanitarian aid in Gaza.
Yeah, Australia also one of those countries cutting off funds to the UNRWA. Bloomberg's reporter Bruce Einhorn there. Let's take a look at how oil is tracking against this backdrop. We're seeing prices for West Texas rising at the moment, $77.96 a barrel, as we await the retaliation from the US for that strike in Jordan that killed 3 US soldiers, injured 25. President Biden saying he's decided on what action he's going to take, but we have no action taking place as yet. Crude prices rising. Plenty more to come on Daybreak Asia. This is Bloomberg.
A Delaware judge has struck down Elon Musk's $55 billion pay package at Tesla. That's after a shareholder challenged it as excessive. The ruling could take a giant bite out of Musk's wealth if it survives a likely appeal. Bloomberg technology anchor Ed Ludlow has more.
The judge, Kathleen St. J. McCormick, is essentially siding with the investor that brought the original suit more than 5 years ago. And that was based on the idea that when Tesla's board awarded Musk this $55 billion compensation package, two issues. One, they weren't clear in explaining performance benchmarking, how Musk would take steps to realize that compensation, but also investor concerns about conflicts of interest or a lack of impartiality in the board awarding the package and their relationship to Elon Musk. And remember, when Elon Musk defended himself on the stand, he basically said, I have nothing to do with this compensation deal. I don't set it. But the judge in this case has made that $55 billion package void. It was the biggest compensation package in history. And what happens next is that Tesla's current board have to come up with a new compensation plan for Musk. And just based on the immediate reaction in Tesla shares in after hours, the market is taking this really seriously. The outpouring of instant reaction on social media was in high volume and severe. And our understanding is that Musk and Tesla will appeal this initial decision. Ed Ludlow for Bloomberg News in San Francisco.
Well, here are some of the corporate stories that we're tracking. General Motors says it plans to reintroduce hybrid-powered cars in North America. The move comes as it faces slowing growth and a troubled production ramp-up for full EVs. But CEO Mary Barra told us GM remains committed to an all-electric lineup by 2035.
There definitely is a slowdown of EV adoption, although a transformation of this magnitude was never going to be completely linear. I think one of the important things is continuing to build out the charging infrastructure, but it's also about having purpose-built, ground-up EVs that have all the performance requirements.
Volkswagen is said to be pushing back plans to list its battery unit, PowerCo, as slowing demand for EVs clouds the outlook for the business. Sources also say VW is pausing talks with investors for stake sales. We're told IPO plans could be revived if the market improves. On Monday, Renault also cancelled plans to list its EV arm, Ampere. The world's top EV battery maker, China's CATL, says profits rose as much as 48% last year thanks to strong sales. The company's preliminary data show net income as high as $6.3 billion, and that beat analyst estimates. Latest data from SNE Research shows CATL's share of the global EV battery market at about 37%, and that's more than double its nearest rival, BYD. Bell.
Thanks, Paul. Yeah, just taking a look at some of the big movers we're tracking today in terms of big tech. We had Microsoft, Alphabet reporting their numbers after hours and really disappointing investors on a couple of different metrics. So for Alphabet here, we saw its search revenue missing. And then also the headline from Microsoft was that focus on cloud growth that fell short of what some on Wall Street were expecting. So we are seeing big tech under pressure today. The other story that we're tracking, of course, is the Samsung earnings that came out. We did see it generating a profit beat for the fourth quarter in the final reading, but still, rather a profit falling again, but still it was a one-time tax gain that did help it along a little bit. So we are seeing chip stocks, though, under pressure so far. More ahead, this is Bloomberg.
got some breaking news out of Australia. Fourth quarter CPI coming in weaker than expected. On year, 4.1%. So CPI is slowing. The expectation was for 4.3%. That's a big slowdown from what we saw in the third quarter, where we had 5.4%. Now, it's the trimmed mean, which is the number that the Reserve Bank of Australia particularly likes, strips out some of those volatile items. That is slower than anticipated as well. The trim mean on year, 4.2%. The survey was for 4.3%. And again, a big slowdown from the 5.2% that we saw back on the third quarter. Let's take a look at how the market is reaction. We've seen the Aussie dollar dip below 66 US cents on that news. The ASX turning sharply positive. We were in the green by just a couple of points a minute ago. Now we're better by 0.4%. So stocks moving higher. That record, though, still a little ways off. We may top it today. What's the record that we're looking for? I beg your pardon, 7632. We are just 1 point shy of hitting that intraday record now on the ASX. All right, let's get a little bit more on those CPI numbers. MLive contributor Garfield Reynolds joins us now. So that was interesting. What are the implications for the RBA?
Well, this definitely puts the seal on rate hikes from the RBA. They're off the table now. You know, we had some talk towards the end of last year, you know, from Governor Bullock and others that, you know, they still wanted to be vigilant, that the last mile for inflation might be harder. You know, this is going to scotch that sort of outlook. There's going to be, you know, some encouragement to the idea that the RBA could cut rates a little bit more in line with some of the expectations, you know, globally, and it's also coming in at a time when there had been hints in recent releases in New Zealand, Singapore, and also the UK that inflation in those places was being a little bit stickier. The idea that Australia is having a significant slowdown like this could well help. You know, we'll see what the Fed says later on today, of course, as well. But it could definitely help global bonds to regain some of their mojo after the recent difficulties they've had.
Yeah, just talk us more through that market reaction, because there has been really scope for pretty strong reaction here.
Yeah, well, I mean, I'm looking at you know, the OIS strip and seeing, you know, 3, 4, 5 basis points lower in the pricing for, you know, where the RBA is going to be, you know, going forward now, and that's the sort of thing that's likely to develop more during the day. We've also got China PMI coming up later on, but, you know, before this data, we didn't have a rate cut for the RBA priced in and fully priced in until September. Now it's likely that by the end of the day you might well get August fully priced in, and then even some, you know, bets on the potential for a June or July cut.
What are the upside risks to inflation, though? Because, of course, these are backward-looking numbers, encouraging as they are, but we still have a war ongoing in the Middle East, which could continue for some time, pressure on potential input prices as well. I guess in terms of rhetoric, we could expect still to hear some caution from the RBA. Yeah,
we could, especially because, you know, one of the big concerns has been, you know, rents, like housing costs. There's not a lot of signs of pressure coming off on that front. The flip side is there's plenty of good news that's kind of filtering through when it comes to power prices. That's been another, you know, major impact, and that's more to do with, you know, local issues than necessarily what's been going on with global petrol prices. So a reduction in those is the sort of thing that is going to help, you know, at the very least, the RBA be confident that they're done. When it comes to rate cuts, they're probably also going to need to see some significantly worse economic data. Now, we did have some worse economic data yesterday, retail sales, which is very much, even the ABS admits, a flawed indicator these days. But, you know, we'll be looking forward to the next jobs data coming up, some of the other indicators as to whether or not the RBA is going to really feel like it wants to move towards cutting rates. And remember, next week, when the RBA meets, we will get a post-RBA press conference. So that's going to be very much a focus, because the expectation is the RBA is going to hold. That was always the expectation. Probably even an upside surprise would have left them on hold. how does Governor Bullock and how does her board regard the outlook for this year? How strongly are they going to push back against the idea that they're going to cut rates by the end of 2024, let alone by the middle of 2024, which is probably what the market's going to be pricing for by the time they meet.
Yeah, that'll be an interesting press conference, all right. And something new from the RBA as well. We haven't had those post-decision presses before. MLive contributor Garfield Reynolds there. Let's take a look at how we're doing on markets after that result. Just to recap for you, CPI in Australia accelerating slower than expected in the fourth quarter, 4.1%. We've seen a pretty profound reaction on the ASX. Did touch that record of 7,632 points briefly, has reversed away from that now, but we're still in positive territory after being kind of tepid all day. Other markets, though, we're seeing a little bit of softness. The Nikkei off by 0.8%. The Kospi pretty much flat, and it's really the index heavyweight Samsung that's dragging the Kospi down at the moment. Samsung off by 0.2%. Big beats on the top line figure of net profit for Samsung, but a lot of that was to do with a one-off tax credit. So the market really waiting to hear more from Samsung about the outlook, particularly around AI and chip production. New Zealand, meanwhile, off 0.5%. Annabelle.
Yeah, Paul, and something else that's going to play into the market reaction today, or action rather, is what we get in terms of the PMI numbers, because China's official January report is set to be released in just under an hour's time from now. At the headline manufacturing gauge level, we're expecting it to be in contraction through the last 3 months of 2023. Bloomberg Economics as well says today's data will show activity revving up before the Lunar New Year holiday, but it might not be enough to provide any sort of convincing evidence that China's economy has finally turned a corner. Let's discuss now with our guest. Raymond Yung is ANZ's chief economist for Greater China and joins us in Hong Kong this morning. So, yeah, Raymond, I mean, even if we do see some brighter numbers coming out of this, it probably won't move the dial too much.
Absolutely. I think it's below 50 is contractionary. And we have to bear in mind that this is a distortion with the Lunar New Year as well. We have a February Lunar New Year this year, and Year of the Dragon, by the way. Then whatever seasonally adjusted impact, that's not going to change the fact that the economy is slowing down and the numbers should be weak.
And so how much does that tell you perhaps we could be setting up for a period of longer-term deflation?
Usually people look at the headline number, but then starting from last year, I started to look at the sub-index, the price sub-index. For example, the selling price sub-index of the manufacturing PMIs has been below 50 for a long while. And I also look at the nominal GDP number that we are forecasting 3.8% this year versus the real growth of our forecast 4.2%, which means that the nominal GDP growth is lower than the real growth. And China is absolutely, already in the deflationary era, I would say, because I don't see any reason or driver to boost price, plus the fact that, domestically, the market has been very, very competitive, and firms and enterprises, they are cutting price. So I think the deflationary trend will continue. I don't see any pickup of the producer price index or CPI in the first half of the year. We have to wait until the second half of the year, then we may be able to see 1 or 2 months of positive PPI.
So far, the policy efforts we've seen from policymakers in China don't seem to be working too much. Is there any sort of transmission effect that's playing into that, do you think?
Well, so far this year, we've seen a triple R cut. The markets were expecting an interest rate cut. It didn't happen in January, and this may happen, by April. Give them a breathing space, to think about what to do. We also expect some fiscal policy before the National People's Congress in March. Then they may start to talk about more bond issue to support infrastructure projects. But overall, all these sort of, piecemeal fiscal stimulus measures are not able to change the market expectation that the slowdown will stop, because this is rather structural rather than cyclical.
Yeah, well, to your point, markets just keep on declining. We've seen the CSI off another, I believe, 2.6% just this week. Can you foresee a scenario where markets really do start to twist policymakers' arms into delivering that big stimulus that they seem to be asking for?
There's a lot of talk about the rescue package, last week on how the authorities are able to stabilize the market sentiment. But look, this is just a sentiment poll. It's not really anything that can change the economic fundamental. So as long as deflation remains, then there's got to be some pressure on industrial earnings, some pressure on companies' valuation, and that's more about how the government is going to change the market expectation, especially in the private sector, and also household expectation about property price. We're not expecting any meaningful recovery in Chinese property market in 2024. So I think that the overall the growth momentum and also the market is rather already priced in, the outlook of Year of the Dragon.
Just to cycle back to what you were saying earlier about deflation, Bloomberg's also reporting today that white-collar wages are falling in China as well. And when you put that alongside all of the other difficulties that people are facing, the problem in the property sector, the declines we're seeing on the share market, at what point does political risk start to build up in terms of the social contract between the Chinese government and the people?
We've seen a strong unemployment pressure happening, in the private sector. China has close to 300 million of rural workers, in the urban area. They are looking for jobs. Many of them are actually working in the construction industry. So I think that the government knows, how important the property market and the property sector is to employment, to wage growth. Without a meaningful wage growth and the private sector real wage or disposable income growth at the rate below the overall GDP. So that's also a main drag to household consumption too. I think that the government knows that this number, like unemployment or youth unemployment, is more important than GDP number. So I believe that this is the top policy agenda this year for the State Council and trying to boost the employment and stabilize unemployment pressure in the urban area. At the same time, they also need to look at how to stabilize the financial, the sentiment in the financial market. So there are two, major objectives that the Chinese government need to focus on: unemployment in the urban area and also financial stability.
Financial stability, though, given that the stock market really just represents quite a small percentage of individual household wealth, and property really makes up a lot more of that. What do you think that tells you then about the actual priorities for financial stability?
I think the Chinese governments care about both, financial stability and the economic fundamental. Now, obviously, the financial stability bit is much more complicated than thinking about any counter-cyclical policy to boost the economy, which is rather straightforward, either through this fiscal policy or monetary policy. But in terms of financial stability, they need to care about, the debt and leverage of both the private sector, the property developers, and also, some financial institutions too. So this year, they are already, trying to strengthen the party control in different financial institutions in terms of senior management and also, how to reform the financial policy within the financial regulators and also the PBOC. I think this will be a major task that the Party Central is trying to address.
Mm-hmm. All right, Raymond, thanks for your time. That was Raymond Yung, Chief Greater China Economist at ANZ. And as we said, those PMI numbers due in about 45 minutes from now. But you can watch us live and see our past interviews on our interactive TV function, TV Go. There you can also dive into any of the securities or Bloomberg functions we talk about. Plus, become part of the conversation by sending us instant messages during our shows. This is for Bloomberg subscribers only. Check it out at TV Go.
You are watching Daybreak Asia. Here are some of the corporate stories that we're tracking. PayPal cutting about 2,500 jobs. That's 9% of its workforce as rising competition puts pressure on profits. In a letter, CEO Alex Chriss says the decision will right-size the company. Those affected will be notified this week. PayPal was an early disruptor in the payments industry, but rivals have since crowded into the space. UPS saw its biggest share drop since April after announcing plans to cut 12,000 management jobs. It says the move will save more than $1 billion. CEO Carol Tomei says the cuts are possible due to new technologies like AI. UPS expects sales for 2024 to come in between $92 and $94.5 billion, trailing estimates. Jack Dorsey's fintech firm Block will begin cutting jobs as part of a goal to cap its workforce at 12,000. Block declined to give specific details on how many jobs are affected. The company announced the cap when it reported third quarter earnings in November. Block has been trying to rein in costs to boost profits. And Bloomberg's learned that UPS has cut a group of senior bankers as it continues to reduce headcount after its takeover of Credit Suisse. Sources say several cuts were made last week. UBS's workforce jumped to about 120,000 when the deal closed in June. The bank says it aims to save about $6 billion in staff costs in the coming years. Bell.
Thanks, Paul. We can stick with that theme of job cuts at banks because we've actually had the Japanese lender Nomura announcing that it's cutting 60 staff, and most of that is in investment banking. That is ahead of its earnings result later today. Mizuho as well is due to report, but it is actually planning to expand its US equity research desk instead. So let's cross to Tokyo and our Asia investing reporter Russell Ward. Yeah, so Russell, it does seem like there's job cuts underfoot. UBS, we just mentioned Nomura, another one. What exactly does it signal to us?
Hi, Bal. Yes, the job cuts are flowing worldwide in the banking sector. Latest, the big news coming from Nomura overnight ahead of its earnings later today. As you mentioned, 60 jobs being cut, 30 in the US, mostly in investment banking. And this, of course, reflects the slump in global deal-making that all banks have been afflicted by, including, on Wall Street. We've had, the big banks there cutting staff on the banking side. But specifically for Nomura, they really had faced enormous pressure to cut costs on the wholesale banking business in recent quarters. Only a couple of quarters ago, revenue costs actually exceeded revenue from that division, so it was losing money. It's managed to get the ratio down to about 96%, but it's really trying to cut that down lower. The CEO last year announced that he was seeking more cost cuts from this division, and these job cuts reflect that. And really, I think it's also just reflecting a tough decision for Nomura. It really is. He's been trying to expand in investment banking in the US, the largest fee pool, and so really these cuts were probably a tough decision for Okuda.
Well, we're going to hear from Nomura a bit later on with earnings today. What can we expect there?
We're actually expecting quite solid results. Profit's going to fall about 26%, but that's mainly because of the absence of a one-time gain that they booked last year when they sold the stake in a research affiliate. But really, this is going to be driven more on the domestic side. The retail business is doing very well. It's recovering very well on the back of the Japan stock market rally. But there's going to be questions, closely watched, figures on the wholesale side, whether those cost cuts are going to show progress, as I mentioned earlier. Also, the fixed income business, that's traditionally Nomura's strength, has had a softer couple of quarters, so we'll have to see what happens on that front as well. But, looking long term, looking ahead, this year started off very well for the Japanese brokerages due to the Japanese stocks being at the 34-year high. Nomura's shares itself have risen about 19% this year on the back of a 30% increase last year. So, I think there are a few tailwinds also for Nomura and its rival Daiwa, which is also reporting today.
Yeah, well, unlike Nomura, which is cutting jobs, Mizuho's planning to add jobs in equity research in the US. So what's the thinking here?
Yeah, I mean, this contrast is very stark. Mizuho has been expanding in the US, like its megabank rivals Mitsubishi UFJ and Sumitomo Mitsui. It's been doing quite well in the equity underwriting. It landed the ARM deal, the IPO from ARM last year, which is a big coup for Mizuho. And so we spoke to the head of the Americas division. He said, look, we've got enough ECM bankers, but now we want to actually complement that by adding to our research. And so it's adding to research in energy, healthcare, and industries. Recent hires included Bill Featherston from Credit Suisse as a managing director and head of America's research. And so, it seems to be on the front foot. As I mentioned, Sumitomo Mitsui is also expanding. It's deepened ties with Jefferies, and of course, the big one, MUFG, is this long-standing ties with Morgan Stanley. So the big mega banks looking to diversify away from Japan and make inroads into investment banking, while Nomura, on the other hand, is struggling a little bit.
That was our Asia investing editor, Russell Ward. And apologies, Mizuho's numbers, they are due Friday this week instead, not today, as I said earlier. But let's take a look at the earnings focus we have today on Samsung, because that company continues to be under pressure. It's one of the biggest draggers on the Kospi so far today in the session. We did have its numbers coming out, the final reading for the fourth quarter, just in the last hour or so. And what we saw was a fourth straight quarter of profit decline. And that was for the key holiday period as well. So net income dropping 74% in the last 3 months of the year to 6.02 trillion won. That's after its mainstay chip operations posted a loss of 2.18 trillion won. So that was more than what economists, or analysts rather, had been projecting. A tax credit, though, that did help lift the bottom line to nearly double what analysts had been expecting. So you can get more on that. We do have a T-Live blog still underway as well, so you can check that out at T-Live Go. This is Bloomberg.
This is Bloomberg News Now.
News when you want it at the touch of a button.
Another volatile day on Wall Street. We're seeing big moves.
All eyes on Capitol Hill as Democrats and Republicans prepare.
Today's job numbers casting doubt on the Fed's next move. Inflation remains front and center. And that's news when you want it with Bloomberg News Now. Get it 24/7 on the Bloomberg Business app, Bloomberg.com, and anywhere you get your podcasts.
Bloomberg News Now. Context changes everything.
All right, let's take a look at how we're tracking on markets here in the Asia Pacific. Here in Australia, we turned sharply positive a little while ago on those CPI numbers. The ASX better by about 1/5%. We're still a few points shy of that record intraday high. However, elsewhere, we've got the Nikkei in negative territory, off by 2/3%. The Kospi pretty much flat. The index heavyweight bell, Samsung, currently off by about 2/3%. That net profit looked like a beat. However, a lot of it due to a one-off tax credit, Bell.
Yeah, it is that big focus on earnings also playing into what we see in US futures so far. But in the next hour, we're really counting down to those China PMI numbers that are due out. It could show that factories started to front load ahead of the Lunar New Year break, but still not really going to have a long-standing impact on equities given the underlying pressures around the property sector. And we'll have more on that ahead with Hang Lung Properties Vice Chair Adriel Chan joining us live.
They're brimming with sensors. There's several cameras that look out at your world because we're mapping your physical world so we could put the content in there. There's several cameras looking at your eyes so we know where you're looking in your physical world. And that's a lot of data. That's a lot of very personal data. There's a number of other sensors on the device that are needed to make it work in the way it does. So we feel strongly that, first of all, people should know what these devices can do. And since we're at the beginning of the curve, let's work on the right guidelines and put those guardrails in place now versus letting it out of the bag and trying to rein it in, several years from now.
So what rules would you put in place, and who should make up and enforce the rules?
I think it's definitely a public-private discussion, but it's a very complex technology. So I actually spend quite a bit of time in DC talking to folks, saying, just educating them on what it could do. But I think first and foremost, the data that it collects, there needs to be an understanding, the user needs to understand the level of data that it's collecting, and then be the one who says where that data goes.
I think I was around so many powerful people in my entire life. From the time I got married to Robert Kardashian and had a whole ecosystem of businessmen and entrepreneurs and people running studios, and any given day it would be the head of a studio, and just often paid attention without really realizing I was paying attention. And I had a very amazing education. I was a housewife. I was raising 4 kids at home. I had the most blessed situation, but at the same time surrounded by these business situations that I didn't even realize were happening right in front of me, but I must have been absorbing it, because there's so many times I've like brought up in my mind one of those conversations that I had learned from.